Hello and welcome back. You are watching Numbers and the Narrative. As promised in the previous edition, today we are taking up the big number for our scrutiny. The big number relates to the country's GDP. The government, few hours ago, released the GDP data for the current financial year based on a new series which promises to overcome the shortcomings, the counter or address many criticisms that were aired about the old method or the existing method that we have been following to calculate our GDP, which many claim that it overstates our GDP compared to what the reality might be. The new series is out, and I have with me a very special guest, Dr. Pronab Sen, who was the country's first chief statistician of India when that office was set up as a statutory body. Welcome back to our show, Dr. Pranab Sen. Let's go straight into the topic. You've seen the numbers. What is your first reaction?
Well, the first reaction is that the numbers look amazingly stable, except for one item, and which is consumption, household consumption. Household consumption has risen very sharply in the current year, 24-25. And that comes as a surprise. Normally, one expects household consumption to grow about a percentage to a percentage, 1.5% lower than GDP growth. This time it's almost the same. And that is a surprise. But that's a pleasant surprise. I mean, as a country, we do need to consume more. But having said that, the other thing which came as a surprise is that the investment figures continue to be depressed. And we are a country which seems to be chugging along at more than 7.5% for several years, and with an investment rate of 32%. Where is this growth coming from? Where is the capacity being created for further growth? Because at 32%, you would be expecting a growth rate of 6 to 6.5% of GDP. Anything more than that becomes stretching it.
So before we get into the detail, let's just take a quick look at what the numbers actually are.
Sure.
The numbers we have today, they put GDP growth for the current financial year at 7.6%, compared to 7.4% that was predicted based on the old series only a few weeks ago. So you see that as per the new series, which uses 2022-23 as a base year, we are now likely to see a GDP growth which is slightly higher than what was predicted as per the old series. But when we look back in 24-25, we also see a similar pattern. GDP growth is now estimated at 7.1% compared to 6.5% that was estimated as per the old series. But here is the big gap. In 23-24, for which we actually have the actual estimates, for 24-25, it's the revised estimates, first revised estimates. They will undergo another round of revision before they actually become the actual or final estimates. In 23-24, we see GDP growth is now estimated at 7.2% compared to 9.2%. Almost a 2 percentage point drop. Now, that brings me to the question, is it that what we had feared, many critics had said that your GDP estimates could be overstated by up to 200 basis points? Is it that we are seeing that criticism playing out in the 23-24 data, where we actually have a more final shape of the data, and maybe that numbers for 24-25 and 25-26 will undergo further revisions, and we might see very different numbers?
Well, actually, you will see revisions for sure, and you will probably see significant revisions because you're doing a lot of new things. Um, but the 23-24 data is what would, I think, conform much more closely to our expectations than the data we are seeing now. Now, why this is happening is really the question. Because really, if you look at the uh, the methodologies that have been adopted, other than couple of new sources of data, of which the most important one is the annual survey of unincorporated enterprises, there is no real difference in the change in data. The change is primarily methodological. So what has happened? The big methodological change out here is moving from singular deflation to double deflation.
Mhm.
And we will have to tease out this because this is done at the sectoral level.
Mhm.
And it's very difficult to look at the numbers and say this is what's happening.
Mhm.
But yes, there would be some new data that would have come in, but whether it would lead to such a dramatic downward revision is really the question. And
Mhm.
so one would really have to look at what the unincorporated sector surveys are saying.
I have a question.
Yeah,
The survey of unregistered enterprises, we did it after a gap of 7 years. Is that right? The one we got for 23-24, that came after a gap of 7 years.
that is right.
And and we don't have uh, any survey after 23-24 for estimating the numbers for 24-25 and twenty-five
Not
twenty
yet,
six, right?
because 24, no, no, now it's an annual survey. So you do have the survey which was done in 24-25, but
Okay.
the data was yet to be incorporated, I think. That will be
Yes,
a part of the
because we
revision.
haven't seen that in the public domain. That data is not yet in the
No,
public
that
domain.
data is not in the public domain yet,
So,
but
so
that
which means
data does exist.
which means it would be fair to assume that the data is still being processed.
Yes,
Yes. Okay.
because
Because
normally it takes 7-8 months for it to get processed,
Okay. So, in
and that
other
is okay.
words, because the real criticism about the old series, or the earlier method of calculating GDP, was that you did not have an independent way of assessing the growth of the informal sector.
Yeah,
You were using the growth of the formal sector as a proxy for the informal sector. Post demonetization, then the subsequent developments such as the GST rollout and the COVID pandemic have made the informal sector actually shrink. Anecdotally speaking, and also what you see around, and therefore the criticism was that the growth of the formal sector as a proxy for informal sector might be leading to overstating your GDP numbers. am i
yeah,
am I moving in the right direction?
yes.
So therefore that big shortcoming still remains unaddressed when we look at 24-25 data, or 25-26 advanced estimate or revised estimate of 24-25, because the annual survey data might not have been baked into it.
No, I mean, I think it has been baked into it, but the annual survey in and of itself doesn't solve that problem.
Mhm.
Okay. And the reason for it is for these annual surveys to be accurate, they need to be based on a fairly sort of up to date economic census.
Mhm.
That's how you choose the companies who you will survey and make them representative. Now,
Mhm.
with the annual survey, what you do have is an estimate of the number of enterprises,
Mhm.
right? But that the amount of credence you can put on that number is questionable.
Mhm.
So, doing the population census and doing the economic census are absolutely essential to establish the credibility of the survey data.
Mhm.
The surveys mm, are only as accurate as whether they represent the population fairly or not. Now, if you don't even have any idea as to what the population looks like, then getting a good survey done is difficult.
Hmm.
In fact, impossible.
Let's just take a look at, probably we'll get some answers, or there are a few things that beg explanation when we look at a little, when we break down in terms of, you talked about the rise in the consumption expenditure and the gross fixed capital formation and all. Now these are the numbers when it comes to private final consumption expenditure, PFCF, gross fixed capital consumption expenditure, and gross fixed capital formation. Uh, what sense do you get comparing how these numbers have changed from old to new? We see a significant deceleration in 23-24 in government final consumption expenditure, and
Yes.
and just the
Which
opposite
is
happened in the following
yeah,
year.
but this is, I'm a little surprised at this. 23, 24, we should have expected a sharp deceleration. Because remember, the year before, you had a huge increase in government final consumption expenditure because of
Yeah.
the pandemic. The pandemic effect was still playing out. And 23, 24 is when you make the correction
Yes.
fiscally. So
Yes.
that does not come as a surprise. In fact, 8.1 was a questionable, which people would have raised.
Yeah.
That was a non-credible number. Um, but what is interesting, and again, if you look at 24, 25, the increase from 2.3% to 6.5%,
Yes.
again is I think is understandable. Because this is when the government again was trying to ramp up the economy uh, quite sharply,
Mhm.
and it still hadn't gotten onto the investment way of doing things.
Mhm. So, when we look at private consumption expenditure, do you think these
Yeah.
numbers kind of conform to what we have been thinking, that private consumption, the growth in private consumption expenditure was probably overstated in 24-25, because we
Yes.
now the news
Yes.
series shows. So
Yes.
this is okay. What about the gross fixed capital formation, which is, yeah, the investment spending in the economy? That also was overstated, not just in 23-24. It was also overstated in 24-25. It has been much lesser than that, the pace of gross fixed
Yes.
capital formation.
And but this doesn't make that much of a difference because we've been oscillating between 30 and 32% of GDP in fixed capital formation.
Mhm.
And this more or less confirms that you're still moving within that band.
And that's not good enough, as you said. That's not good enough.
It's
We
not
need
good
to
enough for
be
7% growth.
we need to be uh, I want to zoom into another table as to how the old and new numbers uh, compare when it comes to different sectors. Uh, yeah, I think this graphic, because of paucity of time, we just took it cut and paste. So I'll try and see. Uh, there seems to be significant changes here. If you look at the private, sorry, the agriculture sector, uh, there is, the old series seems to have been overstating the numbers. When you look at mining, manufacturing, there is a significant upward revision when it comes to the new series. What does it explain? And similarly, across all other services and all, there is certain amount of upward revision, and which is
Yeah.
why you are getting a higher number through 24-25 and 25-26. I mean, is it all adding up to a coherent story, or do you see there are
No,
many
I
things that
mean,
need
that
explanation?
that's where the double deflation issue comes up.
Mhm. Can you explain
You
it to
can't-
our audience, the double deflation issue?
Well, the double deflation, the earlier we used to do what was called single deflation, which is we took the value added of any product and we divided that by the price of the product. But remember, you're taking the value added, which is the value of the product less the value, money value of all inputs going into it. And you take that difference, which is what the company is adding, the value the company is adding, and you divide that by the price of the product. So you're converting the value added in terms of the number of units of the finished product. That was
Mhm.
single deflation. What they're doing now is that they're using the prices of the output separately and the input separately, and then getting two money values and then subtracting one from the other. That is
Mhm.
what they're doing. Now, we've had a period where global commodity prices have gone down sharply, particularly
Okay.
last year. Okay.
Okay.
Now, when that happens, the sector it will mainly affect will be manufacturing.
Okay.
Mining, not so much, but manufacturing for sure, because a lot of their inputs are coming from abroad. And with the
Mhm.
softening of global prices, this is going to reduce the price index that you're using to deflate the inputs.
Okay.
And that's going to push up your uh, real GVA.
So basically, the nominal GDP growth, the nominal manufacturing GDP growth,
It stays the same.
and the real manufacturing growth, between them, the gap gets narrowed,
Correct. Yes.
which is purely because of what's happening to inflation at a input level,
At an
what's
input
happening
level. Yes.
at an
That's it.
input level, and
Yeah.
which may not necessarily be telling us actually you are seeing growth of that kind. So there is an element of
Well,
overstating.
look at the figures, Rajesh. If you look at the figures, it suggests that growth last year, inflation last year for us was only 0.5%.
Now 1%. Now that has the deflator has now got revised to 1% as well.
Yeah, but now most people don't believe it, so that's an issue in itself. But that's how it is. That's what it's
So,
doing.
which means the other criticism of the old series that was there, that you are using a wholesale price index, and wholesale price index is largely driven by what's happening to commodity prices, and therefore, uh, and it is also very cyclical in nature.
It is.
And when wholesale price index gives you a much lower inflation figure, it tends to overstate or artificially push up the real GDP growth. So
Well,
even with
yes and no, Rajesh. You see, that would be true if you're using the wholesale price index in its totality. But the NSO uses it at the product level, product category level.
okay,
Okay, so it's not just that because there's a large presence of input material whose prices have fallen, and therefore the WPI is low. What would happen is those industries that were using those materials, their estimates of production would go up, but for other industries, it might come down.
okay,
So it's not strictly true.
but whatever the case may be, that criticism that you are not getting your deflator right, or you are not being able to adjust the nominal growth accurately to get the real GDP growth, it would seem that that criticism still remains.
That criticism still remains, and in a sense that they're trying to address that by using double deflation, right? But the point is that it doesn't. It in a sense makes it even worse, given that a lot of the sort of softness in pricing was because of imports of global market prices, right?
Yeah,
So it's
because you are
mostly coming in through the input side and artificially raising your real GVA.
Yeah, because 2 of the 3 years you are ending up getting almost an average which is high in a double digit manufacturing growth.
Yes.
And we are not seeing that in corporate results. We are not
Yeah.
hearing that in corporate commentary. We are not feeling it. So,
No,
so would it?
this is the thing that despite the fact that uh, they are using the annual survey of unincorporated enterprises, they are not giving us the breakup between corporate and non-corporate.
They're still not giving.
They're still not giving it to us. Now, the whole charge that was leveled against them earlier was because you had no estimates for the unincorporated sector, you were putting in whatever projection you felt like.
Mhm.
That was what the critics were saying. But now that they're using ASUSC, that charge cannot be leveled anymore. You can then
Right.
question the survey, but you can't level that charge,
Mhm.
right? But please make that data available then.
Okay.
Okay.
Let me
So
move
earlier,
over.
remember, we used to get manufacturing particularly broken up between corporate and non-corporate.
Right.
That's vanished.
That used to happen at an annual level when you used to come
Yeah,
to annual
that's the annual
estimates.
level. Yeah,
Yeah.
and this is the annual level.
Yeah, that's right. That's right.
Yeah.
Let's move over from manufacturing to services. Do
Yeah.
you think, with a lot of other indicators that they have brought in, including using the data that RBI gets from the banking and financial system, and several other high-level indicators that they have used, and there is a full list of the annexure gives a whole airline data, a lot of other data, which is, I think, a welcome development. But do you think getting the services somewhat right or closer to the reality?
I
Because
think,
I think
look, the services was always divided into two parts again. One was where you had balance sheet data. So everything that you're talking about is balance sheet data was there in the past as well. Okay. The
mm,
whole problem is that a very large chunk of our services sector is in the informal sector.
informal sector, it's still
And
not
it's
getting
really
captured.
measuring that, which is the question.
Hmm, hmm. So let me now get out of the inside baseball stuff and ask you a bigger question. The the doubts and suspicion that many have had about the India's GDP data, and some even say that the reason why the equity market has stayed flat for almost 1.5 years, foreign investors are no longer as gung ho about India, is because they don't buy this data that has been coming out. Do you think we'll continue to struggle with that perception problem?
Uh, perhaps not. I mean, look, the fact of the matter is that the Indian corporate sector wasn't doing very well last year and still not doing that great. So the remember the stock market in particular reflects the view of investors on Indian companies, corporates. So they were not wrong, but it doesn't sort of reflect the larger story in and of itself. So
Mhm.
if I have a situation where the MSME sector is growing very strongly at the cost of the corporates, that's a good story to have. But that
Mhm.
won't enthuse the foreign investor
Mhm.
because he has access only to listed companies.
Mhm. But that would have a bearing. You could feel it if that was happening. You could feel it when you see the corporate earnings, or you see
Yeah, corporate earnings
when,
are not doing well.
sorry,
Corporate earnings aren't doing very well.
aren't doing very well. I mean, in fact, when one goes over to looking at volume growth, the story gets even
Is
uh,
very
uh,
is depressing.
worse.
Yeah.
Yeah. Uh, so So, what's the big picture or big message that's going to go out of this new data? I mean, do you think the chief economic advisor responded to a question that After this, will the International Monetary Fund change its assessment about India's economic data? November 2025, the IMF said India's data quality is C grade,
Yes.
which was not a very good thing to have happened. And the chief economic advisor today said that the government hopes, he rather exuded confidence that they have been able to address in the new series almost all the concerns of IMF. Of course, he said that it is up to them now. Uh, so, do you think one would be looking for some kind of a validation now from IMF or other international agencies that are watching? I mean, would
No, we don't really need validation, but that's not the point. The point is that what the IMF was saying was right. Look, we were supposed to have revised the GDP base year in 2017-18. Till then, until that point, the IMF was perfectly comfortable with our GDP estimates. We've always been a high B. All right? 2017-18, you don't do it. You keep delaying, keep delaying, keep delaying until 2023-24. And you actually do the revision now in 2026. Right? Now, over this extended period of time, the credibility of the estimates become questionable. And
Mhm.
what the IMF was saying, in effect, is that you have used various ratios and proportions to calculate a lot of uh, the numbers that you've got there, and we can't trace where these rates and ratios are coming from.
Right.
So we have no idea what you guys are up to.
Yeah.
But if now you're using recent survey data and you put it in front of us saying, here, this is where it comes from, then that should take care of the problem. The problem, I think, is this long delay in revision of the base year.
Right, right, right. I think some of those concerns. I think the CA probably might be referring to those concerns that might be getting now addressed with what they
Some
have
of it
done.
has been addressed for sure.
Part of it getting
Sure, because
addressed.
you have ASOS, you've got an important breakthrough in terms of the corporate data. Now, at least for some of the companies, you can break up manufacturing from services and treat them separately. Those are big steps forward. So there is good news.
Hmm. Before I let you go, my last question is now let us for a moment. I mean, we have what we are seeing. Let us for a moment we say these numbers are not much, may not be much of the mark as far as the reality is concerned. Let us say it's 7% average in the last 3 years. That's still very good growth. And when we break it down, and when we see manufacturing is almost coming close to a double-digit number,
Mhm.
so are services. Uh, I mean, we shouldn't be hearing as much as we are hearing about people not getting jobs, middle class getting squeezed, real wages being stagnant, because there are also other data sets that are
Oh, the
confirming that.
real wages are certainly stagnant.
Even then, even if for a moment we say, well, the new series has cracked it, the numbers are probably right, but even then, there may not be enough reason to celebrate, because probably what the new series data is also confirming, therefore, is that you actually have had a K shaped recovery in the aftermath of COVID.
No, I don't think anybody really questions that. And I don't think even the government had questioned that. The
Well,
K-shaped
they don't
recovery,
acknowledge it.
they don't acknowledge it, yes. But, well, they have in terms of the policy pronouncements,
Yes.
but not in terms of the growth.
The fact that we have decided to feed 80
Yeah,
crore people is
that's
an
right.
acknowledgement
It's
you
an
do have.
acknowledgement.
Yeah,
There are lots of other ones also. I
yeah.
mean, guarantees for working capital for small enterprises, all of those were the sort of reflection of that recognition. But that's not really the issue. The issue is correct, that where is the growth coming from? your investments as a proportion of GDP has stayed roughly the same.
Mm-hmm.
You're not seeing any surge in employment.
Mm-hmm.
So both capital and labor more or less remaining where they were. So where is the growth coming from?
Mm-hmm.
That's the question. I
Mm-hmm.
mean, are we creating growth from thin air?
Yeah. Without capital, without labor,
Without labor,
we have
yeah.
become an innovative country to create output.
Maybe this is the play of technology
Yeah.
or incredible increases in efficiency.
Huh? Let me be the devil's advocate. Uh, could that be also the case? At least to some extent, can it explain? I mean, we have seen with digital technology a significant enhancement in efficiency, and
No, efficiency can explain a lot. Efficiency can explain a lot. But the point is, most of the technologies you're talking about would have to be embedded in physical investments. You'd
Mhm.
have to put these machines into place.
Mm.
Doesn't
that we are
happen
not
like
seeing. That we are not seeing.
that should show up somewhere, no?
Mm. That we are not seeing, or we might be failing to capture
Or
that data.
no, the other way is that your education and training systems have improved. We have no evidence of that.
No, no.
We have-
On the contrary, it might have deteriorated further.
It might have deteriorated. Absolutely.
Mm. Well, thank you very much for your time. So if to sum up, if I may say, well, it can be called a small step in correcting a few anomalies, but the big issues still remain unresolved as far as making the estimates more credible and more dependable. That issue is concerned. But more than that, I think the paradox of our development, where even if we take off, 2 percentage point from what the government is claiming, even with that growth rate, we should not be seeing the kind of unemployment, the kind of squeeze on the middle class, the kind of distress that we see in rural areas and even in urban areas. So that bigger paradox uh, obviously can never be resolved with the new with by a change in a statistical methodology to measure your growth. But what it happens that it comes back to us as a reminder that that bigger paradox remains unresolved, and that should be a bigger concern for all of us. Thank you very
Yeah,
much.
my pleasure.
You wanted to say something?
No, no. I said yes.
Thank
I
you.
mean, methodologies have certainly been improved, but whether it makes us any the wiser is a different ballgame.
Okay, on that note, we shall end here. If you have liked our conversation, please like the video, share it with your peers and friends, and subscribe to us, and keep coming back. Thank you.